yes, it's that time again when bond, equity, and currency markets, probably a few more besides, hang upon every word uttered by central bankers. In the coming week, the US Federal Reserve, the Bank of England, and the Bank of Japan will, for better or for worse, hold centre stage with their latest policy pronouncements on Wednesday the 20th, Thursday the 21st, and Friday the 22nd of September, respectively. To start with the Fed, since March 2022, the American Central Bank has so far taken the upper band of the Fed funds rate to 5.5% from just 0.25%. It's also started to shrink its balance sheet through quantitative tightening, albeit with a bit of a hiccup in spring of this year when three big American banks tumbled in quick succession, and as a result, its total asset holdings are down by 10% from the peak to $8.1 trillion, although that is still double where they were before the pandemic and 8 times the level maintained before the Great Financial Crisis. At this meeting, the Fed is expected to leave the Fed funds rate unchanged at 5.5% for the second time in a row, and as far as markets are concerned, Chair Jay Powell and his colleagues on the Federal Open Markets Committee are done. According to the CME FedWatch, rates are not expected to go any higher, but the first cut is not expected until June 2024. The Bank of England first raised rates in December 2021, since when it's taken the base rate to 5.25% from 0.1% and shrunk its asset purchase programme to £785 billion from a peak of £895 billion. 3 months ago, a rate hike was seen as certain at this meeting, on the way to a peak of maybe 6.5% by Christmas. Now, however, a pause is expected ahead of one final increase to 5.5% in November, and then nothing until the first cut in September 2024. And then we come to the outlier, the Bank of Japan, which is yet to raise rates or indeed throttle back on quantitative easing. Governor Katsuo Ueda has taken over and with the monetary authority has continued to hold rates at minus 0.1%, but he is locked in a battle with both the bond and the currency markets. The yen is sliding, and the Bank of Japan has twice increased its ceiling for the 10-year Japanese government bond yield, or JGB, that's currently prepared to tolerate to a high of 0.5%. So far as this meeting is concerned, no change in the headline rate of interest is expected at minus 0.1%, and nor is there any change expected in quantitative easing. In terms of corporate news, we have a busy week ahead of us, with 8 FTSE 100 members due to update the market in one way or another, and an extensive list of mid and small caps due to do the same. Companies which may be worthy of further note include the following, although some of these dates could still be subject to change. Phoenix Group on Monday the 18th, Ocado, Kingfisher, Moonpig, Henry Boot and S3 on the 19th, M&G, Dunelm, Galliford Try, Page Group and Zara on the 20th, JD Sports Fashion, Halma, SSP, C&C, DFS Furniture, James Fisher, CVS and Warpaint London will make for alphabet soup on the 21st, and B&M European Value Retail and Essential will close out the week on Friday the 22nd of September. But for all of that august list, the company most likely to cause a fuss in the week ahead is next. The multi-channel retailer is due to release its first half results for the 6 months ending in July on Thursday the 21st. The shares are up by a fifth over the past year, helped by a deceleration in inflation, decent wage growth, hopes for a peak in interest rates, and a UK economy that just continues to dodge a long forecast recession. In addition, in contrast to 2022 when profit warnings predominated, Next has spent 2023 upgrading its earnings guidance, and Chief Executive Lord Wolfson nudged up expectations at August's trading update. These interim results will be benchmarked against the forecast for the full year to January 2024 made in that August commentary. After a hot June, in contrast to a wet April and May, strong sales and good clearance rates in the sales, Next stuck to its forecast for full year full price sales growth to rise to 1.8% year on year. Now that implies an increase in full price sales of around 0.5% in the second half after a 3.2% year on year advance in the first 6 months of the year, as revealed in the August update. On a headline basis, the consensus forecast is £5.4 billion of sales for the full year, flat on the prior year. In the first half of last year, by the way, Next chalked up revenues of £2.4 billion on a stated basis. Then attention will switch to pre-tax profit, where Next nudged up its guidance by £10 million to £845 million for a 3% drop on last year's $869 million. And that drop is mainly thanks to higher wage and utility bills. In the first half of last year, Next generated pre-tax income of £401 million. Finally, Lord Wolfson has suggested that earnings per share, or EPS, will drop 7% to 535 pence for the year to January 2024. The drop's due to the increase in UK corporate tax rate, partially offset by a £220 million share buyback as a return of what the company calls surplus corporate cash. Those buybacks reduce the share count, but again, that drop is partly due to higher utility bills and wages. Shareholders will then look to the dividend. Next declared an interim distribution of 66 pence a share a year ago, on the way to paying out 206 pence a share for the whole year. Analysts are looking for a flat payment in fiscal 2024. Hope that you and your families are all keeping well. Thank you for watching, and I look forward to chatting to you again and seeing you again next week.